Hi, this is Roger Conrad. I'm editor of Canadian Edge. What I want to talk about today are two things. One is the general panic that seems to be spreading among some income investors out there, and the use of stops in particular too closely to the price of existing where current prices are, and thereby accentuating the volatility. Regarding that issue, we're getting in the midst of first quarter earnings. They're coming in. Things are looking up. This is actually going to be the strongest earnings season we've had in quite some time, really, but since the big calamity in the latter part of 2008, and probably dating back before then. So the numbers are looking good. That's good news for dividends. We're going through these conversions, and they're coming out pretty positively. We have seen some cuts along the way, but they're all very much within what management has guided us to. And so we're looking at stronger companies. We're looking at potential for gains here as this uncertainty is blown away with trust conversions. And most importantly, we're looking at strong businesses getting stronger. So there's no reason to panic out of the situation right now. I think we're bound to have more volatility, and of course that's accentuated by the fact these things are priced in Canadian dollars. So when we have an environment where people are worried about the economy, as they have at various times over the past several years, and they sell everything and buy U.S. Treasury bonds, you take a double hit. You take the one hit from the fact they're high yielding and they're not treasuries. You take the other hit from the fact that people are selling Canadian dollars to buy U.S. dollars. So that's happening. But as we've seen again and again and again, these things are reversed. And what are the business numbers telling us? Things are getting positive. So we've got an issue coming out, the May issue, a lot of recommendations in there, a lot of good news coming out, and again, a lot of reasons to be positive. Now the second big thing I think to bear in mind here that I want to discuss is the Gulf oil spill. And of course, a lot when you talk about Canada, you're talking about energy, and you're talking about competitors really with offshore oil. It's too early to see what kind of devastation this explosion at the BP well is going to wind up creating. Certainly, there's a lot of potential for a lot of bad things to happen. One thing we do know that's going to happen, though, is that the cost of offshore drilling is going to go up. There's going to be more oversight, and this always, again, happens in the wake of a major disaster. There's going to be more oversight, more regulation, more capital spending that has to go on before these projects can take place. That whole concept of drilling a relief well, you better believe that is going to be part of any major new project that takes place. They're going to and the offshore drillers are going to have to pay more for that. Now, what does that mean for Canadian drilling? Well, it's very good for shale gas, shale oil. It's on land. And Canada is moving in this direction in a very big way. It's also very bullish for oil sands. Oil sands is one of the most expensive ways to produce energy, but it will become more competitive relative to offshore drilling, and particularly deep offshore drilling, given some of these new measures that are going to be going into effect. So again, that's all very bullish for Canada, and at a time when people are very concerned and worried. And valuations are maybe pulling back. I think it's a good time to take a look at your holdings, and also take a look, if you're looking to buy more, take a look at some of these things that maybe come back below our buy targets, or come well below the buy targets, and look to add some. So again, we have the May issue coming out, and we'll look forward to chatting with you next time.